Hey, welcome to The Explainer. Today, we're putting on our detective hats and diving into some financials. Our subject, Aakash Exploration Services Limited. We're going to dig into their reports to uncover the real story hidden in the numbers and figure out what's really driving their business.
So, here's our game plan. First, we'll quickly get you up to speed on how to read these financial reports. Then we'll introduce our company, Aakash. After that, we'll dig into this really curious mystery about their income versus their expenses, check out their overall financial muscle, and then at the end, we'll put it all together for the final verdict.
Okay, so first things first, the best way to think about a company's financial reports, it's like a health checkup for a business. They don't tell you absolutely everything, but they give you a fantastic snapshot of its overall condition. You get to see the strengths, the weaknesses. It's really the only way to get a straight answer on how a business is actually doing. So how do we actually do this health check? Well, just like a doctor has a stethoscope and a blood pressure cuff, we have our own set of tools. And in finance, that means 3 core documents. 3 statements that each tell a really unique part of the story.
All right, first up, you've got the income statement. Think of this as the annual physical. It answers one super simple question. Over a period of time, did you make more than you spent? Yes or no? Then there's the balance sheet. Now this is a different beast. It's a snapshot in time, on one specific day, that weighs everything the company owns, its assets, against everything it owes, its liabilities.
But you know, the one that tells the real story, where the detective work really gets interesting, is the cash flow statement. It's basically the company's bank statement. It just cuts through all the noise and shows you where the actual cash, cold, hard cash, came from and where it went. No hiding. Because look, profit is one thing, but as they say, cash is king. Okay, with that background, let's meet our subject, Aakash Exploration Services. Now, they're a big deal in the oil and gas world, but maybe not how you'd expect. See, they don't actually drill for their own oil. Instead, they're the support crew. They provide all the essential services and gear that help other companies get the oil out of the ground. So, let's put our detective hats back on. We're about to dive deep into their latest financial filings. These documents are our evidence, and our mission is pretty straightforward. Let's figure out what story these numbers are trying to tell us.
And our investigation kicks off with their income statement. And wow, right off the bat, we've got a real puzzle on our hands. It's one of those classic business mysteries, making more money but keeping less of it. So let's start with the good news. If you look at their revenue from operations for the first half of the year, that's H1, and you compare 2021 to 2024, you see this really impressive growth. Sales jumped from about 33.5 crore rupees all the way up to over 49 crore. And by the way, a crore is just 10 million. So that's a huge leap. Clearly, people want what they're selling.
But, and this is a big but, here's where the plot thickens.
When you look at the bottom line, the actual profit they walked away with during that same time, it went the complete opposite direction. It dropped from 2.9 crore all the way down to just 1.3 crore. I mean, that's more than cut in half.
So that brings us right back to our central mystery. How on earth does a company sell way more stuff but end up with less profit to show for it? To crack this case, we got to look at the other side of the coin, their expenses.
Aha! And here it is, the smoking gun, soaring expenses. Take a look. Employee benefits, that jumped from around 11 crore to over 15 crore. And check out other expenses. This is basically all the day-to-day stuff to keep the lights on. That absolutely ballooned from less than 13 crore to almost 22 crore. So long story short, it's costing them a lot more money to make that extra revenue. Okay, so mystery of the shrinking profits? Solved. But that's only one piece of the puzzle. Now let's zoom out a bit and look at the balance sheet. This is going to tell us about their overall financial foundation. Are they built on rock or on sand?
All right, this snapshot from September 2024 paints a really clear picture. You can see they have total assets, that's all their stuff like equipment and cash, worth about 86.7 crore. But the really key thing here is how they paid for all that stuff. And you can see that only about 31% of it is funded by debt, or what they call liabilities. The rest is from their own money. And having a relatively low level of debt like that, that's generally a really good sign of stability. And here's what's so interesting. Even while their profits are getting squeezed, the company is actually making its financial foundation stronger. I mean, look at this. In just over a year, they managed to cut their total debt from 31 crore down to under 27 crore. That tells you they're actively trying to rely less on borrowed money.
And if you needed more proof, just look at the cash flow statement.
It totally backs this up. It shows that 9.1 crore in cash left the company for financing activities in the first half of 2024. And guess what a huge chunk of that was for? Yep, paying back loans. It's crystal clear they're making debt repayment a top priority. All right, our investigation is pretty much wrapped up. We've looked at the income, we've checked the balance sheet, we've followed the cash, so now it's time to put all those clues together and deliver the final verdict. So here's the lowdown. First off, business is booming, revenue is climbing, which tells us there's real demand for their services. That's a great sign. But second, profits are getting squeezed, big time. Why? Because their costs, especially for people and operations, are just growing way faster than their sales. Third, and this is the interesting part, even with those shrinking profits, the company's overall financial health is actually improving. They're getting stronger by paying down their debt. And finally, this isn't an accident. They are deliberately using their cash to get those liabilities off their books.
So, all of this leaves us with one big, fascinating question. What we're seeing is a classic strategic gamble. Aakash is choosing to sacrifice profits today by spending more on its people and its operations while at the same time cleaning up its balance sheet. So the big question is, will this bet pay off? Are these higher costs today just an investment that will lead to way bigger profits down the road? Well, only time will tell.